Morning, everyone. I'd like to welcome you to this public meeting of the New York City Rent Guidelines Board. This is just one meeting in a series of public meetings and hearings to determine renewal lease adjustments for rent-stabilized housing units in New York City with leases commencing or being renewed on or after October 1st, 2015, and on or before September 30th, 2016. Our chair, Rachel Gotzel, is unable to be here. And as per our bylaws, Article 7.7, she asked me to preside over this meeting. I will now take roll call. Please respond if present. Harvey Epstein. Present. Steve Flax, that's me. Sheila Garcia. Present. Cecilia Hoza. Present. Sabir Rahman. Present. Helen Schwab. Present. Scott Walsh. Present. Sarah Williams-Williard. She's absent. And obviously, Rachel asked me to be in her stead, and she's absent as well. Okay. Our next meeting is scheduled for the morning of April 16th at 9:30 here at the Landmarks Preservation Commission conference room. The 2015 Price Index of Operating Costs will be presented at that meeting. Our public meeting here on April 23rd, starting again at 9:30, is a tenant/owner invited group testimony day. Owners and tenant members should get your list of speakers to Andrew by April 20th. As stated on our schedule, speakers representing apartment tenants are scheduled for the morning session, and apartment owner representatives are scheduled to begin at 1 p.m. Hotel tenant testimony begins at 3 p.m., followed by hotel owners at 3:45 p.m. The preliminary vote for rent-stabilized renewal lease adjustments will be held on April 29th at the Cooney Graduate Center, 365 Fifth Avenue in Manhattan, starting at 6 p.m. There are copies of the most current 2015 meeting schedule in your folders, and copies of our schedule are here today. Please note that the final voting meeting and public hearings have been finalized. The final meeting schedule will be posted on our website as well, nycrgb.org, later today. And to my colleagues, the new schedule has the 4 public hearings in each of the boroughs, or 4 of the 5 boroughs. So if you could let Andrew and Rachel know that you're available or not, that would probably be helpful, because those dates are new. It's on the back of the Guidelines Board letter.
Steve, these are the same dates and times, the location, nothing's changed?
Nothing's changed since I sent it down on Friday.
Okay.
Same.
But do let Andrew and Rachel know your availability. Okay, moving further along. The 2015 Income and Affordability Study will be presented momentarily and will be followed by the presentation of the 2015 Mortgage Survey Report. Copies of both reports are in your folders. Also in your folder is a staff memo in response for additional I&E data, which is the same memo that was circulated to the board members on April 27th. Please take note that the annual Conflict of Interest Board Financial Disclosure Report filing period will run from April 6th through May 1st, 2015. Individual packets for board members are here today. Please see Leon before you leave so that you can sign for and receive your packets, although I think you did the packets.
Yeah,
right?
I think we're all.
Everyone's set up.
I got everybody.
Okay. Also, in your folder is a memo from the COIB regarding tips for filing. Okay. At this point, I'd like to introduce Danielle Berger, the RGB Senior Research Associate, who will be presenting the 2015 Income and Affordability Study. Please note that there are copies of this report here today and will be made available at the website at the meeting. Yes.
I just want to be clear that the schedule that we have is final, that the end times are only end times for people to sign up and not, so if someone comes at 6 o'clock for the Manhattan hearing, for the public hearing, we'll still allow them to test.
Yeah,
it,
it's
right?
similar to every year that we've ever done it, yeah.
Thank you.
But that's a good point. Yeah, absolutely.
And we had some issues with entrance last year and sort of flow of population. Is there any way that we can address that? I don't know.
Oh, well, yeah, it's a good point. We switched to the Graduate Center. One of the reasons was that. So there is no Homeland Security. There's no Homeland Security, but it's much easier to enter. There's no metal detectors, and you can just walk right in. So it'll be a lot quicker. So I anticipate the start time being much closer to 6 than it was last time. So to give you a heads up. So
Thank you.
it's a very actually nice space. So hopefully it works out.
That's great. All right, Danielle, thank you.
Okay, good morning.
Good morning.
The Income and Affordability Study is researched and presented each year in accordance with Section 26-510B of the Rent Stabilization Law, which requires the Rent Guidelines Board to consider relevant data from the current and projected cost of living indices and permits consideration of other measures of housing affordability in its deliberations. To assist the board in meeting this obligation, RGB research staff produce an annual income and affordability study, which reports on housing affordability and tenant income in New York City's rental market. The study highlights year-to-year changes in many of the major economic factors affecting New York City's tenant population and takes into consideration a broad range of market forces, rent levels, and public policies affecting housing affordability. Such factors include New York City's overall economic condition, including unemployment rates, the Consumer Price Index, and gross city product, as well as household income and housing costs, the impact of welfare reform and federal housing policies on rents and incomes, and other relevant factors such as the number of eviction proceedings and homelessness levels. In summary, 2014 saw New York City with growth in gross city product, which increased 3.1% during calendar year 2014, the fifth consecutive year of increase. The city also gained 120,700 jobs, and inflation rose at a slower rate than the previous year, with prices rising 1.3% on average during 2014 in the metro area. And real wages increased by 2.1% in real terms over the prior 12 months. The unemployment rate fell to 7.2%, and evictions fell by 6.9% during 2014. But homeless staying in city shelters increased, rising by 9.5%, while the number of cash assistance recipients decreased 3.9%. And the number of food stamp recipients, now known as SNAP, fell for the first time since 2002, decreasing by 5.6%. New York City's gross city product, which measures the total value of goods and services produced, increased by 3.1% between 2013 and 2014, following a 4.0% increase in the prior year. On a quarterly basis, there was positive growth in all but 3 quarters since the first of 2009, including a 2014 quarterly high of 4.2% during the third quarter of 2014. The United States economy saw gross domestic product increase as well, but at a slower rate than New York City, increasing by 2.4% in 2014, and showing positive growth on a quarterly basis in all but 2 quarters since the second quarter of 2009, including a 5.0% rise during the third quarter of 2014. The rate of inflation, as measured by the Consumer Price Index, which measures the change in the cost of typical household goods, rose at a slower pace during 2014, increasing at a slower rate, 1.3%, than the previous year. This rate increase follows increases over the past 3 years of 1.7%, 2.0%, and 2.8%. The U.S. CPI for urban consumers increased 1.6% this year, just 0.1 of a percentage point higher than the previous year. New York City's unemployment rate fell 1.6 percentage points during 2014 to 7.2%. Manhattan had this year's lowest borough unemployment rate at 6.1%, a decline of 1.1 percentage points. Queens's unemployment rate was the second lowest of the boroughs at 6.4%, down 1.4 percentage points from the previous year. Staten Island's rate was 7.2% in 2014, a 0.6 percentage point decline from 2013. Brooklyn had the second highest unemployment rate of the boroughs, 7.7%, a 1.7 percentage point fall from 1 year earlier. And the Bronx once again had the highest borough unemployment rate, 9.8%, and fell 2 percentage points from 2013. The most recently available data for New York City shows unemployment rates of 7.0% in January and 7.2% in February of 2015. The U.S. rate also fell in 2014, down to 6.2%, a 1.2 percentage point decrease. As this graph illustrates, 2014 saw falling unemployment rates for both New York City and the nation as a whole. The New York City rate is in purple, and the U.S. jobless rate is in blue. The rate in New York City is now at its lowest level since 2008, when it stood at 5.6%. Coinciding with falling unemployment rates, employment levels in New York City grew for the 5th consecutive year. Overall, among both city residents as well as those commuting into the city, New York City gained 120,700 jobs in 2014, a 3.0% increase from 2013. There were gains in all but one sector, including the leisure and hospitality sector, which rose 5.6%, adding 21,400 jobs. The construction sector, up 4.5%, adding 5,500 jobs. And the education and health services sector, up 4.1%, or 33,400 jobs. And smaller increases of between 0.1% and 3.9% were seen in other sectors, including professional and business services, information, and trade, transport, and utilities. But one sector did decline. The manufacturing sector, which has declined in all but 3 years since at least 1990, fell 0.5%, or 400 jobs. The most recently available numbers from January and February of 2015 show a 2.9% increase in total employment as compared to the previous January, and a 2.6% increase as compared to the previous February. As this graph shows, New York City gained 120,700 jobs in 2014, the 5th consecutive year of increase. We also look at wage data, though the analysis is limited by the fact that there is a significant lag time in reporting of the income data. The most recent annual numbers, via the quarterly census of employment and wages, which covered the 2013 calendar year and are still preliminary, reveal a 1.8% decrease in real wages, that is, wages that have been adjusted for inflation, and a 0.1% decrease in nominal wages during 2013. The data is based on quarterly tax filings by businesses in New York State and captures approximately 97% of all non-farm employment. During the most recent 12-month period, the 4th quarter of 2013 through the 3rd quarter of 2014, real wages rose by 2.1% and nominal wages by 3.5%. Note that this data is also still preliminary. In the finance and insurance sector, which accounts for more than a quarter of all wages in New York City, wages rose by a real 5.6%. In the administrative, waste, educational, and health services sector, which account for 16% of wages, wages rose by a real 0.1%. In the professional and technical services sector, which accounts for 13% of all wages, real wages rose by 2.0%. And in the government sector, which accounts for 10% of all wages, wages rose by a real 1.7%. Wages also rose in most other sectors. And looking at real wage growth by quarter in 2014, real wages rose by a real 1.7%. Real wages were up 8.4% in the first quarter, 0.9% in the second quarter, and 2.1% in the third quarter, as compared with the same quarters of the prior year. Wage growth in this 12-month period was dampened by a decrease of 3.9% in the 4th quarter of 2013. The Bureau of Labor Statistics also tracks wage data through their current employment statistics survey. This survey is much more current than the quarterly census, but cannot be broken out by industry, is a much smaller sample size, and does not include monetary compensation such as bonuses. Per this survey, weekly wages in New York City during 2014 rose 1.4% in nominal terms and 0.1% in real terms. As this graph shows, both real and nominal wages increased in the most recent 12-month period. Real wages are shown in 2014 dollars and reflect wages from the first 3 quarters of the year shown, plus the 4th quarter of the prior year. Per the 2013 American Community Survey, the New York City poverty rate for all individuals is 20.9%. By borough, it is 12.8% in Staten Island, 15.3% in Queens, 18.9% in Manhattan, 23.3% in Brooklyn, and 30.9% in the Bronx. The poverty rate for all individuals in the U.S. is 15.8%. Looking at New York City by age, for those under the age of 18, the poverty rate in New York City is 29.8%. For those aged 18 to 64, the poverty rate is 18.5%. For those aged 65 and older, the poverty rate is 18.8%. Looking more closely at families in New York City, for all families, the poverty rate is 17.5%. For families with related children under the age of 18, the poverty rate is 24.6%. For married couple families, it is 10.9%. For female-headed families, the poverty rate is 30.6%. And for male-headed families, the poverty rate is 16.4%. Preliminary 2014 HVS data was released in February of this year. This triennial survey of the housing and demographic characteristics of the city's residents found that the citywide vacancy rate was 3.45% in 2014, well below the 5% threshold required for rent regulation to continue under state law. Queens had the lowest vacancy rate in the city at 2.69%, translating into the availability of just 12,070 rentals in a borough with 449,274 rental apartments. Manhattan, by contrast, had the highest vacancy rate in 2014 at 4.07%. Of the remaining boroughs, the Bronx's rate stood at 3.77% and Brooklyn at 3.06%, and the sample size in Staten Island was too low to calculate an accurate vacancy rate. As you can see in this graph, the HVS found vacancy rates varying significantly among different asking rents. As might be expected, apartments renting for the least had the lowest vacancy rates, while those apartments renting at the high end generally had substantially higher vacancy rates. Apartments with an asking rent of less than $800 had a vacancy rate of just 1.8%, while those renting for at least $2,500 had a vacancy rate of 7.3%. According to the 2014 HVS, which reflects household income for 2013, the median income for all households stood at $50,400 in 2013, a 1.6% real or inflation-adjusted decrease from 2010. The median income for rental households was $41,500, a 1.1% real increase. In contrast, owner-occupied households maintained substantially higher incomes, which in 2013 stood at $80,000, almost double the average income of renters, but unchanged in real terms from 2010. The 2014 HVS again found different income levels among those living in different types of apartments. Rent-controlled tenants earned a median of $29,000 in 2013, a 3.6% real decrease. Tenants living in stabilized buildings earned a median income level of $40,600, including a median of $40,000 for tenants in pre-war buildings and $46,000 in post-war buildings, a real decrease of 0.3% for rent-stabilized tenants as a whole, and real increases of 2.3% for tenants in pre-war units and 0.3% for tenants in post-war units. However, tenants in non-regulated units had higher household incomes than rent-regulated tenants at $58,000 in 2013, a real increase of 7.7%. And those living in other regulated units, such as public housing and Mitchell-Lama, earned a median household income of $18,296, a real decrease of 3.1%. Looking at rent levels in 2014, the median monthly gross rent, which includes fuel and utilities, for all rental units was $1,325, a real inflation-adjusted increase of 4.3% from 2011. Rent-stabilized tenants paid slightly less than the typical rental tenant, with a median gross rent of $1,300, a real increase of 5.3%. Pre-47 rent-stabilized units paid a median of $1,266, and post-46 a median of $1,413, real increases of 3.9% and 9.4% respectively. Rent-controlled tenants paid less than rent-stabilized tenants, a median of $1,020, a real increase of 8.1% from 2011, while tenants living in private, non-regulated rentals paid $1,625, a real increase of 2.7%. And tenants living in other regulated rentals, such as public housing, paid $595, an inflation-adjusted decrease of 6.0% from 2011. The HVS breaks down the distribution of renter-occupied housing by gross rent level. As you can see in this graph, of the 2.1 million rental units in New York City, 7.3% rent for less than $500, 7.2% rent for between $500 and $799, 9.7% of units rent for between $800 and $999, 36.5% for between $1,000 and $1,499, 19.7% rent for between $1,500 and $1,999, and the remaining 19.5% rent for over $2,000. Examining the affordability of rental housing, the 2014 HVS reported that the median gross rent-to-income ratio was 33.8%, meaning that half of all households residing in rental housing pay more than 33.8% of their income in gross rent, and half pay less. This is the same ratio as 2011 and equal to the highest ratio ever reported in the HVS. Rent-controlled tenants saw a median gross rent-to-income ratio of 35.5%, an increase from 31.7% in 2011. The median gross rent-to-income ratio of stabilized households is 36.4%, including ratios of 37.0% in pre-war units and 34.7% in post-war units, increases of 1.6 percentage points for rent-stabilized tenants as a whole, 1.5 percentage points for pre-war tenants, and 0.9 percentage points for tenants in post-war units. This ratio is 33.0% for those in non-regulated rentals, a decrease of 0.7 percentage points from 2011, and 30.3% for those in other regulated rentals, a decrease of 0.6 percentage points. And 1/3 of rental households pay more than 50% of their household income in gross rent, a 0.4 percentage point increase from 2011. Another source of rent information comes from the annual American Community Survey conducted by the Census Bureau. Looking at monthly contract and gross rent from 2005 through 2013 in real 2013 dollars shows that from 2005 to 2013, rent has increased in inflation-adjusted terms by approximately $129 a month. The American Community Survey also reports on gross rent-to-income ratios. Looking at these ratios from 2005 through 2013, they have ranged from a low of 29.9% in 2007 to a high of 32.5% in 2011. Rates remained at 32.2% in 2013. One of the many prices tracked in the Federal Consumer Price Index is the cost of rental housing, which increased by 3.0% in 2014 in the New York metro area. For comparison, rents in the U.S. as a whole rose 3.2% during 2014. The same 7 cities are compared to New York each year to see how the rise in rents in our metro area compares to other major metro areas nationwide. Rents in the New York metro area rose faster than 5 of the 7 cities selected, including Philadelphia, Boston, Chicago, Los Angeles, and Washington, D.C., but rose more slowly than rents in San Francisco and Atlanta. Over the 46-year period of rent stabilization, from 1968 through 2014, overall prices in the New York City metro area rose 621%, while the cost of rental housing rose 724%. This is the converse of what happened in the U.S. as a whole, where overall prices rose more quickly than rental housing by 580% and 538%, respectively. Over the last 19 years, the number of recipients of cash assistance, formerly known as public assistance, has dropped significantly, falling 70% since March of 1995, when the city's welfare reform initiative began. During 2014, an average of 342,294 persons were receiving cash assistance, a decrease of 3.9% from a year earlier. Overall, there was a 4.0% increase in the number of new cash assistance applications, with denied applications rising by 3.9% and approved applications by 4.1%. There was also a decrease of 2.2% in cash assistance recipients placed in jobs than in the prior year. But the number of recipients in the Supplemental Nutrition Assistance Program, formerly known as food stamps, fell by 5.6% in 2014. This is the first drop in SNAP recipients since 2002, although levels are still more than double that of the early 2000s. Medicaid enrollment also fell during 2014 by an average of 9.6%. The purple portion of the graph shows the number of recipients in the Family Assistance Program, and the darker blue shows the number of recipients in the Safety Net Assistance Program. The light blue bars represent the number of recipients who have transferred from the Family Assistance Program to the Safety Net Assistance Program. 2014 marks the first year of decrease since 2008. During calendar year 2014, the number of homeless in Department of Homeless Services shelters increased for the 6th straight year. Homelessness among all persons was up 9.5% over 2013 to an average of 54,122 persons sheltered each night, while the average number of families with children sheltered each night increased by 10.5%, and the number of children and families increased by 11.1%. The number of adult families also rose by 9.6%, and single adult levels were up 7.4%. But more families with children were relocated to permanent housing, an increase of 6.1% over 2013 levels. Adult families also saw more permanent housing placements, up 15.2%, but single adult placements decreased by 3.9%. Corresponding to increased shelter censuses, the length of stay in temporary housing increased, up 30 days for families with children to an average of 432 days, up 33 days for adult families to 527 days, and up 17 days for single adults to 316 days. This chart shows homelessness levels for all individuals during calendar years 1984 through 2014. As you can see, levels increased 9.5% during 2014, the sixth consecutive year of increase. The impact of economic conditions on New York City's renters can also be examined through housing court data. Specifically, housing court actions are reviewed to determine the proportion of tenants who are unable to meet their rental payments. The number of non-payment filings in housing court decreased 3.4% to 208,158 during 2014, the third consecutive year of decline. But there was an increase in the number of non-payment filings that resulted in court appearances, known as calendared cases, which rose 4.0% in 2014. Because the number of court appearances rose even as the number of non-payment filings fell, the proportion of filings that resulted in court appearances rose 4.3 percentage points to 61.2%. But due to the number of evictions falling at a greater rate than the increase in calendared cases, a lower proportion of cases that went to trial resulted in eviction, decreasing from 23.6% in 2013 to 21.1% in 2014. And evictions, regardless of the number of calendared cases, decreased by 6.9% in 2014. As this chart shows, over time, the proportion of filings that are calendared, that is, the proportion of non-payment cases that actually make it before a judge, which is in blue, has been increasing over time, while the proportion of those cases that actually result in an eviction or possession, in purple, has been much more steady. In 2014, the proportion of filings that are calendared rose 4.3 percentage points, and the proportion of calendared cases that resulted in an eviction fell by 2.5 percentage points. A new tax credit for renters in New York City was enacted for the 2014 calendar year, the Enhanced Real Property Tax Credit for homeowners and renters. The maximum rebate is $500, and the maximum household income for those filing is $200,000 a year. The amount of the credit depends on both your income level and the amount of rent you pay annually, with those making less than $100,000 a year earning the biggest credits, and those making more than $150,000 a year earning the least. For instance, a household with an annual income of $50,000 a year who pays 30% of their income towards rent would be eligible for a $16.31 tax credit. But if the same household were to pay 50% of their income towards rent, their tax credit would be $87.19. But higher income households, those with incomes of at least $100,000, get a smaller tax credit proportionally. For instance, a household making $100,000 a year would need to spend at least 31.7% of their income towards rent before they would be eligible for any type of refund. As part of his proposed budget for next year, Governor Cuomo had asked for a similar tax credit for renters and homeowners statewide. It would have allowed for owner households who make up to $250,000 a year and renter households who made up to $150,000 a year to get a tax credit of up to $2,000 for owners and $750 for renters. It was not enacted by the legislature in the final budget that was approved in the last couple of days. In summary, the city's economy increased in 2014 for the fifth consecutive year, rising by 3.1%. Gross city product has increased in all but 3 quarters since the first of 2009. And there was an increase in employment levels, up 3.0%, or a gain of 120,700 jobs. The unemployment rate fell to 7.2% citywide during 2014, a decrease of 1.6 percentage points. Real wages decreased during calendar year 2013 by 1.8%, but rose during the most recent 12-month period by 2.1%. There were decreases in the number of cash assistance cases, which fell for the first time since 2008 by 3.9%. There was a decrease in non-payment court filings of 3.4%, while evictions fell by 6.9%. But homeless levels rose for the 6th consecutive year, up 9.5%. Thank you, and if you have any questions.
Great job, Danielle. Are there any questions from board members? Harvey. Harvey first.
Sorry.
Scott, do you want to go first? You go ahead. I have a bunch of questions.
Oh, okay.
Sir. So poverty rates, can you talk about the change in poverty rates over the years? You talked about being a little over 20% right now, but you didn't say how the poverty rates changed in New York over the last 20 years?
It's reported in each report that we do, but it's only been reported by the American Community Survey since 2005. So if you'd like the rates since 2005, I can compile those.
That would be great. And you talked about the vacancy rates, and I noticed the vacancy rate for units under, I think it was $500 at 1.8%. But does that include all households? Like that could include NYCHA or Section 8 buildings. Those are included in those vacancy rates?
It's the overall vacancy rate.
And do you have those vacancy rates for those units for just stabilized apartments?
I don't have the raw data from the 2014 HVS yet, so I can't run anything until I get those. If you'd like it run...
That would be really useful to figure out what the vacancy rates at different rent levels for stabilized units. That would be, I mean, if it 1.8 includes all NYCHA and affordable housing programs, I'm wondering what it is just for stabilized units.
Okay.
And so just another question around those, so 421A buildings that have market rate tenants basically, that's in that figure too, because is there a way to separate the high rent 421A units versus the affordable 421A units in whatever calculations you do?
Which calculations are you talking about?
Vacancy rates and information, and
I can't figure out 421A units from the HVS, but you asked me to do the vacancy rates by rent level, so. If you want units higher than that, that'll be part of that, but I can't specifically say that they're 421A units.
Right, but you'll be able, I guess we'll figure that out, or we won't, but they'll be over 2,500.
Yes.
Right.
Did you do the same for the income? The same?
You mean the amount of income, or?
Because you cite like 40,600 as like the medium.
Right.
And can you do the same based on where people live?
By where people live or by their rent level?
By both, because I feel like that number is really high, but it also includes 421A tenants in that average, right? And it includes everybody.
It includes everybody, but it is a median, so it is the middle number. So you have people that are very low, which we know is a fact, and you have people that are very high, which we know is a fact. So it's not necessarily skewing anything, but I can, when I get the raw data, do it by rent level.
Yeah, and this gross income to rent ratio that you said is at 36% for stabilized tenants. Can you look at I didn't see that over time. Is there a way to look at that, how the rent burden has changed over the last decade for stabilized tenants?
Yes.
That would be useful to figure out if, you're saying that a third of the tenants are paying 50% or more of their income towards rent. Is that number a constant number, or is that number increased over the last 10 years?
Okay. Again, and this is not going to be anytime soon because I don't have the raw data.
Fair enough. Scott? Yes.
Okay, hi. I just had a question on the note on page 9, the forwards onto page 10. It's just talking again, which I think we all have a lot of questions about the Section 8 and how it impacts the raw numbers.
So it discusses a gross rent to income ratio exaggeration by as much as 4 percentage points. Is there a way to get more clarity on that and to see that over a greater time period? I know that it's a triennial, but could it be done for a couple more triennials back?
It can. I can't do 2014 right now, but I can go back and do that.
Any other questions from the board? Thank you, Danielle. At this point, our next order of business is the presentation of the 2015 Mortgage Survey Report by our Research Director, Brian Hoberman. Please note that there are copies of this report here today and will be made available on our website after the meeting as well. Thank you, Brian.
Maybe we can ask.
Good morning. Since the 1980s, the Rent Guidelines Board has been conducting the mortgage survey, which gives a sample view of the lending market faced by borrowers. The board is required by the rent stabilization law to consider the cost and availability of financing in its deliberations. In compliance with the law, each January, we send out surveys to financial institutions that underwrite mortgages for multifamily properties in New York City. The survey covers 4 main areas: new and refinance loans, underwriting criteria, non-performing loans, and the characteristics of buildings in lenders' portfolios. The survey findings are collected in our mortgage survey report, which highlights changes in the New York City multifamily lending market during the prior year. We divide the report into 3 sections. First, the cross-sectional analysis, which looks at all the respondents. A longitudinal analysis, which looks at only those lenders responding in both the current and prior year. And in addition to the survey analysis, we also examine rent-stabilized building sales data. Each winter, the Rent Guidelines Board surveys institutions that offer loans for multiple dwelling, rent-stabilized properties in New York City. The survey sample is updated each year to include only those institutions that continue to offer new and refinance mortgages. This year, 10 responses were received from the 28 surveys mailed, a 36% participation rate. This is 4 fewer lenders than responded last year. The number of participating lenders declined because the highly competitive lending market did not allow them to make any applicable loans this past year. Before we go into detail, I'll give you a brief summary of our key findings. Interest rates charged on loans decreased. Upfront fees, called points, for mortgages increased. Vacancy and collection losses declined. Lending volume for new loans decreased, but remained stable for refinance loans. Maximum loan-to-value ratios increased. And in our analysis of building sales data, the number of rent-stabilized buildings sold in 2014 decreased. Average interest rates decreased this year. This year's average interest rate for multifamily mortgages was 4.27%, a decrease of 0.62 percentage points, or 13% from the previous year. This is the lowest average interest rate in the history of our survey. This graph shows average interest rates charged for new mortgages over the past 3.5 decades. The graph illustrates that interest rates were once significantly higher, residing in the double digits throughout the 1980s, then fell to single digits in the 90s. This year, average interest rates declined to their lowest level in the survey's history, 4.27%. Points, which are upfront service fees, increased since last year. The average service fee charged on new loans by lenders was 0.70, up from last year's average of 0.54. Among survey respondents, average points this year ranged from 0 to 2.25 points, with 2 surveyed lenders charging no points on new loans. This graph shows the average points charged for new mortgages since the early 80s. After averaging between 1 and 3 points in the 80s and 1990s, average fees have been below 1 point since 2000. This year, average points rose 0.16 percentage points to 0.70. The average volume of new mortgage originations fell this year, while the number of refinance loans remained stable. An average of 49 new loans per institution were financed this past year, a 20% decline from the average of 61 the previous year. The average number of refinance loans remained unchanged at 46 this year. Lenders surveyed, for the most part, remained flexible in the loan terms they offered their borrowers. Since survey respondents typically provide a wide range of terms rather than a single number, we can't give a precise average for the range of terms offered by institutions, but they remain similar to those offered in recent years. Mortgage terms reported by respondents fell within a wide 5 to 30-year range. 2 lenders offered terms as long as 30 years, and just 1 offered a maximum of 5 years. This year's lenders, on average, made small adjustments to their lending standards. For all institutions, the typical maximum LTV ratio, that's the maximum dollar amount respondents were willing to lend based on a building's value, ranged from 65 to 82.5%. The average was 74%, up from 72.7% in the prior year. The debt service ratio, which is NOI divided by debt service, fell slightly this year, with an average debt service requirement of 1.22 compared to 1.24 the prior year. Overall, just 1 surveyed lender reported making changes in their underwriting standards since last year. This graph illustrates lenders' standards for maximum loan-to-value ratios since 1996. After declining in the late 1990s, it rose upward most years in the early to mid-2000s, but fell in many years over the past decade. However, it has been rising over the last 2 years. The LTV ratio has increased from 72.7% last year to 74% this year. A rising LTV ratio benefits borrowers because lenders are increasing what they are willing to lend based on the building's value. Respondents were asked whether their new financing rates, refinancing rates, loan-to-value ratio, and debt service coverage requirements for rent-stabilized properties were higher, lower, or the same as for other properties. Every lender except for 1 reported that standards were no higher for stabilized buildings than for non-stabilized properties in all 3 categories. Fewer lenders reported that they had non-performing loans this year. Just 1 lender reported having non-performing loans, down from about a quarter in the prior year. Of the lenders with non-performers, they make up about 5% of their portfolio this year, compared to 2.2% among the lenders last year. In addition, not a single lender reported foreclosures this year, compared to 23% of lenders last year. The typical size of buildings in surveyed lenders' portfolios varies. The most commonly reported building size is either 1 to 10 units or 50 to 99 units, with 30% of lenders reporting either one. The remaining lenders reported an average of either 20 to 49 units, 20%, 11 to 19 units, or 100 plus units, 10% of each. Average operating and maintenance expenses and average rents among buildings and lenders' portfolios went in opposite directions among surveyed lenders this year. Expenses declined 9.3% to $598, while average rents rose 18.5% to an average of $1,475 per unit per month. Because average costs fell and rents rose, the average cost-to-rent ratio decreased to 40.5% from 52.9% last year. Average vacancy and collection losses decreased this year for the 4th time in 5 years, down from 3.35% last year to 3.25% this year, the lowest level in this survey's history. Similarly, a lower proportion of lenders reported losses of 5% or more this year, down from 31% last year to 20% this year. Like last year, all lenders reported that buildings in their portfolio contain commercial space, though the average amount varies depending on the lender. Among the lenders, buildings containing commercial space represent on average 30% of their portfolio, up from 20% last year. Looking at vacancy and collection losses over the last 2 decades, they have ranged from between roughly 3 and 5% throughout. In recent years, vacancy and collection losses have fallen in 4 of the last 5 years, including this year, falling to 3.25%, their lowest level since we began collecting this in the survey. The survey asks lenders about their portfolio's performance compared with expectations at the time of initial loan origination with regard to NOI, debt service coverage, and expenses. Little change from last year, with the majority of lenders reporting that their expectations had been met or exceeded in all 3 areas among their stabilized portfolio. Specifically, 2/3 said expectations were equaled or exceeded in all 3 categories. The survey also asks lenders whether they retain their mortgages or sell them to secondary markets. Among the lenders, all but 2 respondents retain their mortgages, the same proportion as last year. Now we'll move on to the longitudinal analysis. This year's longitudinal data is similar to this year's cross-sectional sample because all but 1 lender reported data in both last year and this year. The average interest rate among the longitudinal group for new loans was 4.38%, a decrease of 0.65 percentage points from the prior year when the average interest rate was 5.03%. Similar to the cross-sectional group, average points offered by lenders increased among the longitudinal group, up from 0.53 last year to 0.73 this year. The average maximum LTV ratio rose this year, increasing to 73.9% among the longitudinal group, up from 71.4% last year. By contrast, the average debt service ratio declined slightly, down to 1.22 this year, compared to 1.24 last year. Unlike the cross-sectional analysis, vacancy and collection losses among the longitudinal group rose slightly to 3.28% this year compared to 3.25% last year. Looking at the rate of delinquencies among the longitudinal group, just 1 lender reported non-performing loans this year compared to 3 last year. And examining foreclosures, as we discussed in the cross-sectional sample, no lenders this year reported foreclosures versus 3 last year. Now we'll move on to an analysis of rent-stabilized building sales data. About 8 years ago, the New York City Department of Finance began offering online public property sales information. Using this information, we've analyzed rent-stabilized building sales in each of the last 7 mortgage survey reports. This year, we follow up with a look at the data from calendar year 2014 and compare some of the data to what was found in prior years. In 2014, 1,356 buildings containing rent-stabilized units were sold in New York City, 5% fewer than in the prior year. While sales volume declined by 33% in Queens and 16% in Manhattan, it rose 23% in the Bronx and 5% in Brooklyn. And as in prior years, we do not analyze Staten Island data because there are too few rent-stabilized building sales in that borough. Looking at sales data by building size, sales fell in every category. Among the smallest sized rent-stabilized buildings sold in 2014, 6 to 10 unit buildings, sales volume declined 3% citywide. They fell 7% among 11 to 19 unit buildings. Among 20 to 99 unit buildings, they fell 4%. And among the largest buildings containing 100 or more units, sales fell the most, down by 33%. This graph illustrates over the last dozen years, sales peaked in 2005 when 1,816 rent-stabilized buildings were sold. However, by 2009, sales volume declined to 521 buildings. Since then, sales volume increased in most years, but fell this past year in 2014 to 1,356 buildings, a 5% decline from the prior year. Now we'll move on to a brief analysis of sales prices of buildings in 2014. The median citywide sales price was $3.2 million. By borough, the highest median sales price was in Manhattan, almost $6.9 million, followed by the Bronx at just under $3.5 million, Brooklyn at almost $1.6 million, and Queens at about $1.3 million. Further looking at sales prices by building size, among the smallest buildings with 6 to 10 units, median sales prices citywide were $1.2 million. Among 11 to 19 unit buildings, median prices were $3.5 million. Buildings with 20 to 99 units sold at a median price of $5.9 million. And among the largest buildings containing over 100 units, they sold for a median price of $22.5 million. So we'll sum up the major findings of the 2015 Mortgage Survey Report. We found that interest rates fell to their lowest level in the history of the survey, as did vacancy and collection losses. Further, lending terms remained favorable to borrowers. And finally, the number of rent-stabilized buildings sold this past year declined. Thank you, and I will now take any questions you might have.
Thank you, Brian. Yeah, if you could turn off that machine, that'd be good. I'd like to start with that. I'd like to start with some questions, actually. Given the size of the survey, do you think it adequately reflects what's really going on in the market? And I guess that's for your personal opinion, just 10 respondents in a very sort of a growing sort of market. And also, of those 10, were there any non-traditional sort of lenders part of the equation, meaning the equity and sort of the hedge funds and so forth that are entering the market as of late?
No, I think it's a very limited survey, and it has declined. We don't have any of the non-traditional lenders like you suggested. And I wish we could get more. I know we make an attempt each year to add lenders, and you're helpful in trying to do that, I know. But unfortunately, it's not as accurate a measure as we would like.
Just to speak to that, I think the floor of the number of loans it represents, I believe, was 290. Was that right, Brian?
It sounds right. I don't have the exact number, but it sounds right.
So there were 290 that we know of. Not every institution reported how many they made.
So from the 10 respondents, there were 290.
290 is the floor, but there is more. We don't know what that more is. And comparing it to the number of sales in that particular year, which was 1,300, you can sort of glean from that what's going on with it does represent some portion of what's being done out there, right. But obviously...
But there's blanket mortgages that may have 6 or 7 rent-stabilized property as part of one mortgage. It's sort of... There's a lot going on. There's a lot of moving parts, and so that's what's sort of confusing.
Right. That number used to be more like half of what we were getting, I think, of what was sold, so that I think it was more significant.
Right.
And this is only new money, not refinances, or does it include refinances? It's everything, I assume, right?
Well, we count the number. We ask them for the number of new and refinanced loans. You can total up what we have in Appendix 1 and there are actually several that don't respond at all to the number. They don't break it out, I guess, that specifically. So we don't know how many are there. And plus, I know of banks that have large volume that just haven't responded in years.
Yeah, I think the key here is finding a carrot, because the stick doesn't work, or the carrot's not working, and we need a stick. I don't know how because my colleagues at my institution were just apprehensive to respond because they felt it was proprietary. And so obviously only 10 respondents felt the same way out of a growing universe of people that are trying to enter this market. So we can think it through later, but right. it's a tough nut. So I apologize. Any other thoughts, questions?
I would also say, like, if you look at, it's not much different from previous years as far as like the number of surveyed, the number of respondents, right?
We sent out roughly the same, but the decline was it was significant, sizable proportion compared to last year.
Right.
14 to 10. But if you look back, maybe like 10, 15 years ago, we had maybe 30 respondents or more. I don't remember exactly, but it's it's significantly less than used to respond to it.
And some of that has to do with institutions buying other institutions and merging, and so some of that was lost from that as well.
Mm-hmm.
But we're going to take a look at it in the off season, see what we can do to try to increase where we're getting our data from. But it's less significant than it has been in the past. There's no question about it. But
Harvey?
Brian, I'm wondering about publicly available data and whether you looked at that data. I mean, I appreciate that. So we know that borrowing money is cheaper. That's publicly available, and that with the rents are up. But the issue around foreclosures, that potentially, even though there was no foreclosures in your summary, do we know compared to foreclosure rates in multifamilies for last year, for the year before? Can we see the trending on that from publicly available data for the multifamilies?
I could look into that.
And it's interesting around the decrease in collection losses, and I'm wondering, I know the sampling size is a question, but I'm wondering if there's other ways to get at that information to figure out. I mean, it could just be this sample, and it might not be accurate, but it could be accurate that there's collection losses throughout the industry, and that would be useful information to have as well.
Right, we could look into that too.
Any other questions? Okay. If not, thank you, Brian.
Okay, thank you.
Okay. Are there any other additional board business and or discussion? Harvey?
Yeah, Andrew, I'm just wondering who are our panels? I know, when is HCR coming? We talked last year about having the Furman Center come. They've released a few reports on rent-stabilized housing. I'm wondering where they are on the lineup and kind of...
HCR is for May 28th.
May 28th.
Which is our meeting here.
So that's our last public.
Yeah, that's May 20th. We usually, HCR usually comes to that meeting. So HCR will be there.
And when do you need questions for HCR?
Yeah, I'll send around what we've had in the past. I usually like to get that to them a month in advance. So what I'll have...
So if you could send that around soon so we could look at that.
I can send it around now, and I'll have copies of it in your folder the next time around as well. So I can send around last year's questions and responses, so whatever you have for that. We're in the process, and I think we've confirmed this, Danielle Hernandez is going to be at the next meeting from HPD. He's the gentleman, when Liz was here, Liz Gomer asked about, he's the one that's going into neighborhoods about affordable housing and getting information from the community and talking to owners, both owners and tenants, and getting an idea of what's going on in the ground of those particular things.
So we're having the price index.
And the price index is next week. Jim Hudson will be back again this year to speak.
You mean the 16th?
The 16th, right.
So,
I say next week, 2 weeks. 2 weeks.
So
Thank you.
we're getting
I need it.
So we're having HPD and also Jim Hudson on the 16th?
On the 16th, that's the schedule.
And questions for HPD, when can we submit those questions if we have any for HPD?
I submitted all those questions you had for HPD. I haven't heard back yet, all those additional data requests. I don't know if you'd have additional ones beyond that.
I don't know what you submitted, so could you circulate the questions you submitted?
Oh, yeah, sure.
So we could see what the questions are, if there's additional questions we need answered?
Yeah, I'm not sure if Danielle's going to be the one who would be able to respond to those, but we can further them back to Liz, yeah. So Jim will be here. What we're doing is we're actually using, there was a discussion last year of changing the weights over using the I&E weights.
Right.
We're doing that this year, in the process of doing that. So the number that we release with the price index will be the updated weights from the I&E. So the reason why Jim's coming back is to explain that process further, of exactly how we did that. So he'll be at the meeting as well as our normal presentation. Additional, I'm open to. I know there's some discussion about the Furman Center, but I would have to have a specific, what you want to talk about. So if board members want to put that forward, you're more than welcome.
When they've released 2 to 3 reports in the last year. They released a report last spring that we you sent around, but we didn't have someone come and talk about their reports and the impact on their reports on the impact on rent-stabilized housing in New York and what they've seen is trending. So they have some good information. It'd be great to figure out if someone was part of the report could talk to us about their findings and their information.
We should speak to Mark Willis, the head of the Affirmative Center, see if he's willing to come in on the 28th or on one of the additional hearings, perhaps.
And then beyond that, obviously, the folks that are that you're going to bring on the 23rd, obviously, let me know. Anyone that, on the owner or the tenant side.
You want that by the 20th?
If I can get it by the 20th, just I have to set an agenda. So if you guys can get that to the great. So whoever you want in that 2-hour span.
And that's true for the
I usually
landlord
deal.
side
I
as well.
usually speak with Larry Wood on the hotel side, so I can talk to him again. He usually organizes that. So
We'll make sure that he knows that that's
yeah,
a good day.
I know he knows because he told me. So, but I can contact him as well. But anybody else you want to come, and then on the owner side, Scott, I can talk to you about this after the meeting. But usually there's some organization.
Yeah.
Between them. Okay. So. But that's what's on the line.
I mean, I could probably set up the owner's panel right now. Be Jack there.
So that's what we have. But always open to suggestions of whoever.
Okay, so
I'll see.
Do you think that you can get to talk to somebody at the Furman Center way before the 28th so that they have enough
that would
notice?
be the targeted date. Yeah.
To,
Usually we've had Furman here at least on one other occasion, if not 2 or 3 other occasions over the years. So they usually respond and come. They like to do that. That's their gig. They enjoy it, so that's fine. I have no problem with that. Yeah. Obviously, all these things that it's Rachel makes the final decision on this stuff, but
I doubt if she'll be
I
opposed.
don't think it will have any problem. But.
It just makes for a longer meeting. It is what it is. Any other questions or business? Okay, on that note, I want to thank everyone for coming today. Do I have a motion to adjourn?
Yes.
Second the motion?
Second.
Okay. That concludes the meeting of the Rent Guidelines Board. Our next meeting will be here in this room on April 16th in 2 weeks, starting at 9:30. Again, thank you all for coming.